This is joint work with Wild Song, Asher Prasad for Cornell University, and I'm Daniel Rabetti. I'm with the National University of Singapore. Is everything okay? Can you hear me? Okay. Should I continue? I don't have any feedback. Is everything all right?
Yes.
Okay. Okay, perfect. So just a short preview. We are interested in this paper to look into the DeFi protocol, the centralized finance market. Market that started in 2021, boomed, and today is in a starting a more mature phase where all the protocols total value locked is about $15 billion. So there's a lot of products right there in the different applications. And one thing that's interesting for us is that the smart contracts they operate in a blockchain that has some limitations. So blockchains they work in isolation, but some market solutions such as oracles enable those protocols to access information from external environments. So we want to look into first what are the determinants of the DeFi protocol to adopt Oracle, and second whether that has any effect, positive or negative, into from the integration, if there's some enhanced interoperability between protocols after protocols starting integrating centralized Oracle networks. We call it DON just for convenience. And finally, we are also borrowing from, drawing some parallels with the international economics literature, which say that some countries, they are more resilient in times of crisis. We will adopt that analogy to these DeFi protocols to see whether those that have done integrated into their systems, they are more resilient to negative shocks in the DeFi protocols. Again, just to get some idea on what is helping us to drive this effect, we treat digital platforms as a cyber countries in work integration is bridging ecosystem as the equivalent of international financial integration. So here's an example. We see that the blockchains, they're operating in isolation, which means that on one hand, these systems, they are protected from external threats. However, there are some limitations, especially for financial products that they cannot access, for instance, information on weather or something like that. These oracles, what they do, they introduce a bridge between these ecosystems that are isolated, information that's coming out from the world, such as weather conditions or price feeds that can be used in the smart contracts within the blockchain ecosystem. And by doing so, that improves the range of financial applications that these smart contracts can now produce. And as a consequence, we see a booming on applications such as centralized finance lending that takes the price feeds from using these protocols, these oracles. Now, on one side, the oracle is enhancing the array of products or services that the DeFi protocol can now achieve. However, on the other hand, is also introducing a single point of failure. If this is one node now that's bringing this information from external environment into the blockchain ecosystem, not only is violating Satoshi Nakamoto idea of decentralization, but is also bringing a possible potential one point of a failure for the system. So imagine that a Oracle now is corrupted, so all the system that depends upon this in price feeds will be working under stale or erroneous data. Now the market has a solution for that, so created what's called the centralized Oracle networks, where you have, instead of just one Oracle, a network or a chain of oracles that work together in using some systems to find a consensus that could be trusted hardwares or some algorithm or reputation systems in order to provide that information into the smart contracts. Of course, now if one of these nodes are corrupted or stop working properly, then the other oracles can actually replace it, and the information is not the system is not being affected. So we are interested to see, well, there's some strong conceptual basis on why default protocols could be integrated with DOMs in order to achieve full potential and increase in dimensional or increase the number of services and the quality of services provided. However, we do not have any empirical evidence on whether actually incorporating the decentralized Oracle networks helps these five protocols to thrive. So this is something that we are doing in this study. We believe we are among the first, if not the first study to try to tackle this question empirically. Overall, our findings suggest that there are positive effects for a DeFi protocol in incorporated DOM. In this effects we see on the economic activity of these DeFi protocols, in the user base, in the number of transactions. There are some effects as the mass of the DeFi protocols integrate the DOMs increases. We see symbiotic gains among integrated protocols. And perhaps more importantly, we generally see that the DOM actually overcomes these issues that Oracle introduced of a single point of failure, and perhaps it emerges as a core element for an effective functioning of the defined markets. So the market for Oracle is starting 2018 with Market DAO. Here's a snapshot I took earlier this morning of the evolution. You see them right now. There's more than 40 oracles in the market. It's becoming more and more competitive. However, the market is still dominated by one Oracle service provider called Chainlink that has more than half of the marketing total value locked. For this study, we're looking to 15 or more than 1,500 decentralized finance protocols, most of them allocated in industries, popular industries such as centralized exchanges, yield farming, and decentralized lending, and so on and so forth. There's some interesting findings. We see that some industries such as centralized lending, derivatives, and predictions market, for instance, they are highly dependent upon data feeds. So those are industries that are more likely to incorporate oracles in their services. In general, the percentage of the DeFi protocols that integrated DOM is still very small. It's about 18% of the market. So there is a room here for greater DOM integration, since we find that DOM actually provides substantial positive effects to these protocols. On average, the centralized finance protocols will incorporate DOM before the DeFi protocol deploys the main smart contracts. We call it going live, but a few of them will also incorporate after going live. On average, the days to integration is about, at mean, a little bit more than a month, and in the median at 7 days before a protocol goes live. The services that's most dominated for those that integrated DOM is price feeds. This is about 80%, but some of these oracles will also provide other services. So here we start looking to the determinants of the central of DOM integration across these DeFis, or empirical examination in this table had the response variables and indicator variable whether DeFi protocol integrates DOM or otherwise. And we see some intuitive relationships. For instance, the size of these protocols as the protocols grows, they are more likely to incorporate oracles, suggesting that once the range of services already being provided has some sort of threshold, and now the protocols want to increase the number of products, then we will incorporate oracles in order to launch more products. We also see that some of these industries, they are more likely to incorporate, as we saw before in a snapshot of the summary statistics, such as derivatives, lending options. That data feeds are crucial for these protocols to well function. And also DeFi protocols that are operating across multiple chains. Now, this is intuitive because if I have a protocol where in Ethereum and another in the same protocol, and now it's launching Avalanche, if they have oracles, they actually can communicate among themselves. So here's an example of how incorporated oracles not only affect the DeFi protocol, but can affect an entire blockchain. So look into Avalanche, which is a relative young chain compared to Ethereum, for instance. And Avalanche, when it started incorporating oracles in the chain, we see a massive growth, about 88 times the total value locked in the post Dawn integration. Now, this is driven mostly because Avalanche, by incorporated Dawn, now has access to data feeds and can start launching some applications such as decentralized lending. So this is an example that we can see that the effects of the Dawn integration at the blockchain level. We look now into integration effects at the DeFi protocol level. We are interested in two aspects of these potential effects. One is the total value locked, which is the total value of all assets that are in a smart contract in dollars. And we can use it as a proxy for economic activities. And we also look into the market capitalization effects. So we see that protocols that incorporate decentralized Oracle networks and compared to their peers, they have their path of growth. They grow faster than the protocols that do not integrate. That happens for total value locked, which enhances the economic activity and also with market capitalization effects. Of course, there's, even if you are controlling for some of the characteristics that are likely to affect the economic activity and market capitalization of its protocols, and within categories and blockchains, there may be some concerns with endogeneity on characteristics that we cannot observe. So we conducted a matching procedure that improves and approximates the two groups, those that the protocols that have integrated DOMs and those that do not. We redo our analysis, and the results, they still remain, especially for the long window. We also look into protocols with post live integration, and construct a synthetic control for this group in order to see whether there's a difference in the economic activity, or measures a total value locked in the longer run. When we capture using this test about 30% more enhanced total value locked in the long run than in their synthetic control. So now we see that there are some positive effects at the DeFi protocol level. So we're interested to see what happens at the chain level, as whether there's some symbiotic gains for when this all the protocols started now incorporating oracles in Seoul, and they are able to communicate with other protocols in other chains. So we use the total value locked correlations to measure proxy for symbiotic improvements. We look into the Avalanche case. We can see that after Avalanche incorporated the oracles, their total value locked correlation with other chains such as Ethereum, for instance, Phantom, Harmony, and others, drastically improves. Here, as you can see, the changes are positive and also significant, especially in the case of Ethereum. So, Ethereum is well known for establishing the first smart contracts and originating the decentralized finance market. Now, if you look into whether there are symbiotic gains for the DeFi protocol, among the DeFi protocols within a certain chain, as this mass of integrated DeFi protocols increases, and again using the experiment total correlations for total value locked, we have a very interesting findings in which we can draw parallels with the international economic literature. For instance, in the international economic literature, we see that financial integration influences the cross-country cumulative fluctuations such as GDP, which for us, the economic activities are captured with TVL, so there's some similarities here. We can see that as the masses of integrated protocols increases for 7, 14, 21 within one specific chain, there's gains, or there's increase in the correlations among those integrated protocols. So their economic activity is now becoming more correlated. There are also threshold effects, something that we see also in the IE literature. After a particular number of integrated protocols, the gains are still there, but we find some diminishing marginal returns. And finally, we also see that the volatility of these correlations, they are actually negative, which, so, if you, again, drawing parallels from the international economic literature, the cross-border financial linkages actually improves risk sharing, which could be the case. So now we have a feeling or some intuition or empirical findings that substantiate a potential path where those integrated protocols could be more resilient during times of crisis. Before that, we're going to look into whether this potential economic growth or economic activity growth is driven, what's the economic channel, the underlying economic channel that's driving this economic activity growth. And we test also our specifications on on-chain activities, on the number of users and transfers, in particular DeFi protocol and the on-chain activity. We find that we're using these similar specifications that we had before for the total value locked, but now looking to number of users and number of transfers, that also the positive effects are there. So potentially the total value, the economic activity that you're capturing that's being enhanced with the Oracle integration is being driven by a more enhanced number of expanding user base and those users having more transactions and more activity on those protocols. We also, want to mitigate heterogeneity concerns, so we do the test for the matched samples for these network effects, and those the results remain. So again, back to that point that there's the integration increases within a chain, and so the volatility of the economic activities of two integrated protocols are negative, meaning there are some risk, that there may be some benefit of risk sharing. Well, we want to actually empirically test whether integrated protocols are more resilient during times of crisis. So what we do, we look into two extremely negative events that happen in the DeFi market. We are looking here to the coefficients that they are standardized market capitalization. Luna crash, which happened in May 2022. And we see that the blue dots, which are the DeFi protocols with integrated oracles versus their peers that did not integrate oracles, they bounce back faster. So they do recover from a crisis faster than their peers. We use another exogenous shock or another extremely negative event, such as the FTX collapse, now later 2022. And again, we see that the DeFi protocols with integrated oracles, they recover fast from a crisis than their peers. So let me conclude. This study is guided by international economics literature, and we use some of the finds on that literature to examine similarly in the DeFi market. We find that DeFi protocols that integrate oracles, they have benefits. We document benefits in their economic activities and also in their market capitalization, potentially driven by an economic channel, which is an increasing number of users, and these users became more active on these protocols. Despite some concerns of risks arising from integration, we do document that DeFi protocols that integrate oracles, they are more resilient in times of crisis than their peers. Of course, there are a few caveats that we shall mention. One is that this is still a young market. There may be some disruptive technology that may change how these protocols interact, and also potential upcoming crypto regulation could reshape the way that this DeFi landscape is. So I will leave it to here. I really appreciate again the opportunity, and I'm looking forward to further discussing comments. Thank you very much.
So let me start with a quick summary of the results. So using novel data on more than 1,500 DeFi protocols and DAWN adoption history, this paper documents the following. First, the following DAWN adoption platforms experience an increasing TVL and market cap. And there are also symbiotic gains from enhanced interoperability between protocols, which leads to positive network effects. Specifically, in integrated chains and platforms show positive correlation in their TBR growth after DAWN adoption. And also user base and on-chain transfers both increase post DAWN adoption period. Finally, the DAWN improves the risk sharing and the resilience of the protocols in the DeFi ecosystems. Following the Luna and FTX shocks as experiment, protocols with the DAWNs, they more quickly recover their value than protocols without DAWNs. Overall, I think this paper makes very important descriptions and analysis on price oracles and their economic impact on the DeFi ecosystem. To the best of my knowledge, this is the first study that empirically documents the economic consequences of DAWN adoption on the growth and network resilience of DAOs. And also many results in this paper show the importance of information aggregation and risk-sharing benefits across chains, extending the key intuitions that are already documented in the international economics literature. Despite these all great results, I have a couple of lingering points regarding selections and channels and DAWN heterogeneity and multiple DAWN adoption issues, which is my discussion all about. So just to share the market with the audience, let me just briefly describe the use of Oracle in the DeFi ecosystem. So let me use the MakerDAO, Maker protocol as an example. This is the most famous lending protocol, and you can see the users who borrow stablecoin DAIs, and also there are governors who hold Maker tokens who make the decisions on the terms and conditions of how this protocol is working. And above, you can see the maintainers, one of which is the price oracle. So Maker actually protocol balances demand and supply of DAI. So to make the value pack to $1. So how to ensure DAI's value? Usually Maker actually holds vault. Within the vault, there are actually ETH and other valuable crypto assets. They are actually backing up the DAI's value. The vault tends to be over collateralized. But if the vault value falls too low, then the vault is automatically liquidated and paid off to the vault owners. At the same time, DAIs are burnt by the protocol. So supply is reduced, DAI price increases, coming back to the $1, the potential pegging target. Here, actually, who checks the collateral value and also provides the price information to this Maker protocol. The keepers and oracles, they are doing this job. Oracles not only used in this lending protocol, they are also used in the DEX. So in the DEX, oracles help compute the ratio of two assets in the liquidity pool, as well as the total amount of assets within the pool. Oracles are also more importantly used these days because there is a growing asset-backed securitization of the real-world off-chain assets in a via token. This is what we call tokenized securities. So the securities that are tokenized vary from traditional financial assets to the unconventional assets like IP rights and also NFTs. So actually these oracles bring the off-chain real assets price data to on-chain, connecting the two dots. Oracles not only connecting these two dots, but also connect various chains online, spurring the interchain transactions such as wrapping and bridging. So what's the important issue in this market of Oracle? There is a rise of Oracle manipulation attack. As you can see in this graph, in the 2022, the total value stolen due to this Oracle manipulation reached $403 million. I just gave you the two examples of Oracle manipulation attacks. The typical type is the Oracle governance attack. Let me give you the one example in the Maker protocol. Maker holders, the Maker are governance tokens, so they can choose the list of trust oracles through their proposal votes. They can do malicious Oracle manipulation attempts. If Maker holders, they hold large amount of CDPs, collateralized debt positions, then they tend to inflate ETH, the collateral price. If the Maker holders instead hold large amount of DAI, then they actually deflate the ETH price and try to burn DAIs and then enjoy the appreciation in the DAI price. According to the chain analysis report, low liquidity collaterals, they are shown to be more vulnerable to this Oracle manipulation attempt. And there is a salient evidence on this liquidity issue of the token that's associated with the Oracle governance attack. Mango Markets, that's the example, that's the DEX on the Solana. There is a hacker who targeted this thinly traded token, Mango. This is the governance token. The hacker opened the two accounts on the Mango Markets. On the one account, the hacker sells short 500 million Mango. And the other account, using this leverage, the hacker bought the same amount of Mango. And also at the same time, the hacker actually further buy Mango tokens on other DEXs for the push up the Mango price. And this price manipulation is feasible because of the illiquidity of this Mango token. What happens after doing this? The hacker has cashed out the inflated Mango position by borrowing against it, by borrowing USD coins, against this inflated Mango as collaterals. Upon the event, the Kanav in Korea, the president of Jump Crypto, in his Twitter account, said, like, geez, the attacker pump and dump the Mango token, which is thinly traded token. Oracles just report the price. PIF accurately report the prevailing prices on exchanges. So what do we learn from here? And not every dawn is safe, and not every dawn is alike. There is some dawn called first-party Oracle, like a PIF, just directly feeding the data from the off-chain to on-chain without data validation. But there is also a third-party type Oracle Chainlink, which does the data validation process additionally. So security features could be different across dawns. So here are my comments given these backgrounds. First, selection biases could be an issue to identification. Protocols that focus on thinly traded assets and protocols with a poor governance, they may not be, still not safe from this Oracle manipulation attack, even after dawn adoption. That means the positive dawn adoption effect is more likely for the protocols with a strong governance and ample liquidity. So part of the results could be explained by these selection biases. Table 5 actually determines dawn adoption, what determines the dawn adoption rates, and the strong protocols tend to adopt the dawn. And also interestingly, there is very low adoption rate among DEX sector. Only 7.76% of DEX adopts this dawn protocol, which indicates maybe the sector is dominated by one or two very famous protocols, and they tend to endogenously adopt the dawns. So my suggestion is I want to see more detailed cross-sectional distribution summary of the size of the protocols in each industry. If selections could be a serious issue, then more skewed sectors with a few dominant protocols would show relatively lower dawn adoption rate. And also, according to what I study, using the similar DeFi Llama protocol data, many of these protocols are small, and they seem to show highly centralized, the token ownership, without proper governance. So token liquidity and degree of decentralization as a proxy for governance could be additional control variables you can consider. And more importantly, I think I appreciate the authors doing a lot of work to avoid and overcome these selection biases, but there could be some more that could be done because the covariates, staking and FDB, they seem to be highly skewed variables. So that the mean difference test may not be sufficient to ensure the complete balancing. So to ensure complete distributional balancing at the higher moments, maybe the authors can conduct some alternative the analysis like an inverse weighted ATT or overlap weighted ATT that ensures entire distributional matching in these covariates. I used this methodology in my RFS paper last year, and the implementation is not that complicated, so it could be doable. My second comment is about the channels and the dawn heterogeneity. I believe the user base and TVL growth, they are all outcome variables or outcome of the dawn adoption rather than underlying channel. So the channels for dawn adoption could also be a little bit different from the channels we learned from the traditional international economics literature. Maybe dawn adoption actually bring investor confidence by improving security and governance of DeFi protocol. If so, this security enhancement channel could be the channel of the result. And for this part, maybe the authors can actually explore potential heterogeneity within Dawn. As I showed, not every Dawn is alike. And actually, I summarized this for the authors, comparing chain link, pith, and band, how they differ across various dimensions. There are actually various security features that ensure one oracle does a better job than the other. So the authors can explore this heterogeneity and show how the positive Dawn adoption effects vary across the different oracles. Now, lastly, the multiple Dawn adoptions seem quite prevalent in the data. These are the chains, the blockchains that use both chain link and pith. So just to double check, when is if there are multiple Dawn adoptions, how to set an adoption date. If there are multiple adoptions, there could be some confounding effects. So just to be aware of this. And I have just quick policy suggestion, like just think about whether the single dominant Dawn, like a chain link, would be more beneficial to the DeFi ecosystem, or should we encourage more evenly distributed Dawn's market? So overall, this is, I think, a very important and interesting paper. So I think I encourage reading this paper to everyone who are interested in this noble market of price oracle. Thank you.